Every time a currency collapses, the story sounds the same. A government made the wrong decision. Inflation got out of control. People lost faith in their money. But beneath these explanations lies something far more organized and far more deliberate. In the shadows of the global economy, an invisible network has learned how to profit from chaos. They don't create currencies, they destroy them. And in that destruction, they find their greatest power. Today, we'll uncover the hidden hand behind every currency crash. But before we begin, tell me which country you're watching from in the comments below. Because what you're about to hear connects every nation, whether rich or poor, to the same invisible system. If you look back through the last 100 years of economic history, you'll see a recurring rhythm: boom, bust, collapse, repeat. But what if those collapses weren't just accidents of bad policy? What if the timing, the speed, and even the scale of these events were carefully engineered? Economist Charles Kindleberger once said, "Financial crises are like waves, but someone is always pushing the water." That someone, as it turns out, has changed shape over time, from governments and empires in the 20th century to corporations, hedge funds, and data-driven traders today. Let's go back to the first big collapse that revealed how powerful this hidden hand could be. In October 1929, the world saw what happens when trust disappears overnight. The US stock market crashed, wiping out over $30 billion in a single week. Within months, banks failed, companies folded, and unemployment spread like wildfire. On the surface, it looked like a chain reaction of panic. But behind the scenes, another story was unfolding. At that time, America's entire monetary system was based on gold, a system that made money scarce and wealth concentrated. When the Federal Reserve raised interest rates to protect the dollar, it strangled liquidity and collapsed demand. By 1933, President Franklin D. Roosevelt made a stunning move. He banned private ownership of gold, forcing citizens to hand over their coins and bars to the government. It was, in effect, a silent transfer of wealth, from the public to the state, justified in the name of stability. The hidden hand wasn't a single person. It was the system itself, using crisis as a mechanism of control. Fast forward to 1971. The United States had spent decades financing wars and welfare with dollars it didn't actually have. Foreign governments, sensing weakness, began demanding gold in exchange for their dollar reserves. But there was a problem. There wasn't enough gold left. So, on August 15, 1971, President Richard Nixon went on live television and made a decision that changed global finance forever. "I have directed the Secretary of the Treasury to suspend temporarily the convertibility of the dollar into gold." With those words, the Bretton Woods system, the gold-backed monetary order that had held since World War II, was dead. And for the first time, money became entirely faith-based. From that moment on, the value of a currency depended not on gold, but on trust. And trust, as history shows, can be bought, sold, and manipulated. Almost overnight, the power shifted. Governments could print unlimited money. Central banks could stimulate or cool economies at will. And for the first time, markets became a playground for speculation, where massive fortunes could be made betting against entire nations. The hidden hand had evolved. It was no longer about who printed the money, but who controlled the flows of it. It was September 16, 1992, the day Britain lost control of its own currency. For weeks, speculators had been attacking the British pound, convinced it was overvalued under the European exchange rate mechanism, a system meant to stabilize European currencies before the euro. At the center of it all was George Soros, a Hungarian-born hedge fund manager who saw weakness in the system. He bet that Britain couldn't defend its currency forever. And he was right. In a single day, the Bank of England burned through $27 billion trying to prop up the pound. But by midnight, it surrendered, and Soros made $1 billion in profit. To the public, it was called Black Wednesday. To the financial world, it was a masterpiece, a real-time demonstration that even governments could be broken by the markets. It was also a turning point. From that day forward, traders and institutions realized that by pooling massive capital, they could force entire economies to bend. Currency crises became tools. A weak country's debt, its reserves, even its political system, all became opportunities for leverage. And in the background, an invisible hand began guiding these storms, not through conspiracy, but through incentive. Because in a system where money is trust, whoever can control fear can control value. By the 1990s, finance had become globalized. Information traveled faster than governments could react. Capital could move anywhere, instantly. And those who understood this speed used it. As the internet revolution began, trading floors turned digital. Banks evolved into multinational machines, moving billions across borders with a click. And while this created prosperity for some, it also magnified risk for everyone. In 1997, this system would meet its next breaking point, and it would begin not in New York or London, but in Bangkok. It began quietly, a whisper in the markets, a rumor in the corridors of finance. In July 1997, Thailand's central bank made a desperate decision. It abandoned the fixed exchange rate of the baht. What followed was a financial contagion that would engulf an entire continent. Within days of Thailand's devaluation, investors fled. Currencies collapsed across Indonesia, Malaysia, South Korea, and the Philippines. Stock markets lost half their value. Millions lost their jobs. The IMF rushed in with billion-dollar bailouts, but the medicine was bitter. Higher interest rates, budget cuts, privatizations. To the world, it looked like a regional mismanagement story. But deeper analysis revealed a familiar pattern. Before the crash, huge sums of Western hot money had flowed into Southeast Asia, chasing high yields and easy credit. The same institutions that pumped in the cash suddenly pulled it out, and as local currencies tumbled, they bought back assets for pennies. In less than a year, Asia's economic miracle turned into a bargain sale. Once again, wealth didn't disappear, it simply changed hands. Economist Joseph Stiglitz would later write, "The crises were not accidents. They were the predictable outcomes of a system designed to serve capital, not nations." The hidden hand was no longer invisible. It was the system itself. Global finance operating faster than governments, above borders, beyond accountability. In 2008, the hand returned, this time wearing the suit of Wall Street. After years of easy credit and financial engineering, the US housing bubble burst, Lehman Brothers collapsed, AIG followed, and once again, global confidence shattered. But here is what most people missed. The very institutions that triggered the collapse were rescued, while millions of ordinary citizens lost their homes, jobs, and savings. Trillions of dollars were printed overnight. Quantitative easing, they called it. It was the largest transfer of wealth in modern history, from public debt to private profit. Stock markets recovered within a year. The middle class never did. Behind the curtain, the cycle repeated: inflate, collapse, consolidate, repeat. Each crisis removed small players and concentrated power into fewer hands. By the 2010s, the game had evolved. Trading no longer required human emotion. Algorithms took over. Artificial intelligence could analyze headlines, tweets, even weather data to predict currency moves before central banks reacted. In milliseconds, billions could move across borders, manipulating values faster than any government could respond. This was the birth of high-frequency finance, the silent pulse of the modern economy. And behind the code, the same motives remained. Profit from volatility, not stability. In 2010, the flash crash erased nearly $1 trillion in market value in just 36 minutes, a glitch triggered by automated trades. It was a glimpse into the future, a world where machines could crash economies by accident, or by design. Then came the pandemic. Within weeks, global economies were frozen. Governments printed more money than ever before in peacetime history. Inflation followed, supply chains fractured, and once again, ordinary people bore the cost while asset markets soared. But something new was born out of that chaos: digital currencies. Bitcoin promised freedom from the system, but soon the same institutions entered the crypto space: hedge funds, banks, and venture capital. The cycle began again, only this time on blockchain. Meanwhile, governments worldwide began testing CBDCs, central bank digital currencies. Officially, they were meant to modernize money. Unofficially, they represented the perfect tool of control. A currency that can be tracked, frozen, or programmed, all in the name of security. For the first time, money itself could obey. So, who is the hidden hand now? It's not one man, not one institution, not even a conspiracy. It's a network, an architecture of incentives, data, and dependency. Every nation relies on global trade. Every government borrows in global markets. Every investor seeks short-term gain. And that's what makes the system self-sustaining. A crash in one country can send profits to another. A crisis in one market fuels opportunity elsewhere. It is not a secret plan. It is a perfectly legal machine powered by greed and fear. Currency crashes have become tools, reset buttons for economies, pressure valves for debt, and opportunities for those who can see the storm before it hits. The hidden hand isn't creating chaos out of spite. It's maintaining control through instability. From 1929 to 2023, the lesson is constant. Every economic collapse has winners and losers, and they're rarely the same people. The Great Depression centralized banking. The 1971 Nixon shock centralized monetary power. The 1992 and 1997 crises globalized speculation. The 2008 crash consolidated corporate dominance. And the 2020s digital era may centralize control entirely. The tools have changed, from gold to code, but the hand has not. Imagine a world where your salary is a line of code, your savings exist only as digits, and your access to money depends on algorithms you'll never see. In that world, every transaction, every purchase, every donation is data. And whoever owns that data owns your future. The same hand that once pulled the strings of gold and paper now hovers over the servers and satellites that define our economies. So, the real question isn't whether another crash will happen. It's when, and who will benefit when it does. Throughout history, empires have risen and fallen, not because they ran out of power, but because they ran out of trust. Money is, and always has been, a story we tell ourselves. A shared illusion backed by faith, and managed by those who know how to shape that faith. The hidden hand doesn't need to stay in the shadows. It's hiding in plain sight, in our markets, our apps, our debts, and our desires. And perhaps the only way to break its grip is not to fight it with fear, but to understand it with knowledge. The next time you hear about a currency crash, remember, it might not just be an accident. It might be the hand of history, reaching once more for control.